One of the important areas that I think is often overlooked is actually doing year-end tax planning. There's very little you can do after the end of the year when it comes to tax planning. Sure, there's some stuff you can do with retirement plans and that sort of thing, but most of the planning that you actually need to do, you need to do it before the end of the year. And typically, I would say most of the time in the November timeframe. I think it's very important if your CPA does not reach out to meet with you, that you reach out to meet with your CPA sometime during the month of November. Go ahead and get that on the books as early as you can and start looking at what needs to be done. This year, we have got a new tax law, the Big Beautiful Bill. What you're going to learn is that the Big Beautiful Bill actually extended a lot of the provisions that were already there. So really, there's not a whole lot of tax law changes that are going to impact you by the Big Beautiful Bill. The one that may is the bonus depreciation that's now 100%. Basically meaning if you purchase assets, you can take 100% of the cost in the first year. This is important in the sense that it can help you expense the assets right away rather than depreciate them over a 3 to 5 year period. However, for most assets in a dental practice, you're going to be able to take a deduction for them under 179 regardless of what the bonus depreciation is. So the only one I really see that impacting a lot is if you're looking to buy a car in the dental practice. I think it's always important when you're planning to look at planning on a 3-year basis. You're going to want to sort of have some idea of where the practice is going and what tax brackets you're in each of the next 3 years. We typically see practices grow, and most dentists ultimately end up in the higher tax bracket. So it doesn't make sense to purchase equipment in an earlier year that we may get an additional 10% tax savings a year from now or possibly 2 years from now if we don't really need the equipment. Again, we never let taxes drive business decisions. If it's something we need or it's something that's going to produce revenue, then we want to go ahead and do it. One of the strategies I've seen a lot of dentists use and a lot of CPAs use that I don't necessarily like is to defer revenue or to pull expenses forward. That works great for that 1 year, but once you do it, you typically have to do it every year. So unless you foresee a major change in your income in 1 year or another year, that's really not that great of a long-term benefit. In states that have state income tax, most of the states have created what's called a pass-through entity election. This allows the entity to pay the tax and be able to deduct the tax at the corporate level, even if you're not able to deduct it at the individual level. This may not be quite as useful as it was previously now that the tax bill has changed the amount of the deduction from $10,000 to $40,000, but the election is still valuable for those of making over $500,000 who would no longer be able to deduct their state tax. I think it's important to sit down and go through with your CPA on things like retirement. Have you fully funded your retirement plans for the year? Loss harvesting. Have you got capital gains that are going to be coming from mutual funds and stocks with losses that you can offset against those? And just any other types of business advice that can go down and get you ready. The worst thing is to have a surprise. Nobody should have a surprise if they've met with their CPA unless something has managed to change dramatically right at the end of the year. I would appreciate any questions that you have sent to questions@mydentalcpa.com.